today I'm going to talk about the practice question 6, empirical evidence on CIP and UIP. So it has two parts. Part 1, key point in the lecture slide. So part 1 questions basically ask you to summarize key point from the lecture slide. For example, the first one, the question 1 and 2 are about the empirical evidence on CIP. The first question asks you to explain why CIP condition can be violated during the financial crisis based on the Barber and Becker. So you need to take a look at this slide, and this is the hint. And the question 2, they'll try to ask you to explain why CIP condition can be violated using these three papers. So these are very simple based on lecture slide. More important question is in the part 2. So part 2 questions. So this kind of question could be in the exam. So let's take a look at this one. And when we try to answer this question, we can go back to other papers and also key point from the part 1. So this is the questions about empirical evidence on CIP. Kim Deal, a foreign exchange trader working at the AMBS hedge fund in New York, has uncovered or discovered, find persistent violations of CIP for dollar and Mexican peso. Using historical data, Kim Deal implement an FX strategy exploiting this opportunity and confirm spectacular dollar returns. Explain the reason why such return can be considered as a reward for taking risk. So this question is about CIP violations using USD and MXN. When you try to answer these kind of questions, first, I recommend you to write down the CIP form using, in this case, dollar and Mexican peso. What I mean by that, I'm going to use the key review slide here. So when you write down the answer for that kind of questions, first write down CIP form. So this is the form you can use. Person left. Okay. So what is the meaning of this CIP form? So let's say F is pound and D is dollar. If you have £1, you can put £1 into pound money market. This is the one you're gonna get after one period. That's what is in the left hand side. What is in the right hand side? Instead of putting your £1 into the pound money market, you can convert pound into dollar. That's this part. And put that dollar amount into dollar money market. And after one period, you can convert dollar back into pound using forward contract. So what you have in the left hand side and right hand side, these are two returns from two equivalent investment. Why they are equivalent? We are assuming the following things. First, default-free deposit, which means when you put £1 into pound money deposit, even though you do that today, you know for sure after 1 year you're gonna get this amount, default-free. Well, also, if you put dollar amount into dollar deposit, you know for sure you're gonna get this amount after one period. So that's for the default-free part. No counterparty default risk means if you make a forward contract today, the actual exchange of money will happen after one period. So at the maturity of forward contracts, so we're not sure whether the actual exchange of money will happen. So that's the counterparty default risk. The counterparty of the forward contract may not fulfill its promise. You made a forward contract today, maybe counterparty will not fulfill the promise. We assume that is not the case. And we assume also no transaction cost. Given these three assumptions, both are risk-free investment. So what is the law of one price? Law of one price says same risk, same return. So if you buy default-free deposit, if you do this one, there are no risk on both sides. The return should be same. Now, last week, or I mentioned this one. Actually, we can relax these assumptions. This can be defaultable bond. Defaultable bond. Or defaultable T-bill. What is the meaning of that? Maybe when you put your money into pound money deposit, there are small chance of not getting money after one period. Default risk. So we can allow small default risk here. We can allow small default risk here. Then why we are still able to make this equality? Well, it's again low bond price. Low bond price actually in finance says same risk, same return. It doesn't have to be no risk, same return, same return. So if the risk involved with this one and this one is same, then we still get the equality. Same risk, same return, right? So these are CIP you need to define first. Now, so you write down the CIP formula and you put the one as a dollar, the other one, so for example, D as a dollar, F as a Mexican peso, and you explain the CIP violations means maybe inequality, equality doesn't hold. So either this inequality or this inequality, right? Then you have CIP violations. Now, given the situations, how would you implement arbitrage strategy? Now remember, this is Mexican peso, and what you need to do is first check whether these kind of assumptions are still true with the currency you have now for dollar and Mexican peso. First of all, when we learned CIP and when we learned how to exploit CIP violations in topic 2.1, we were using so-called external currency or euro currency. What is the meaning of this? For example, in London, you can borrow dollar or you can lend dollar or you can borrow euro or you can lend euro. So you can borrow and lend foreign currency without that much issue in London. We assume when we put deposit here, it's a euro currency deposit, right? That's our assumptions. But for our question now, we are talking about dollar and Mexican peso, CIP violations. One problem with this one is actually there is no borrowing and lending of emerging market currency in the external currency market. So the basically LIBOR type things is not available for Mexican peso. So we cannot exploit CIP violation between these two using external currency market. Then how can we use this one? We could use treasury bill. So instead of using money market deposit, we can think about CIP violations for USD and Mexican peso using treasury bill. So it's something like this. If you have one Mexican peso, you can put that in, you can buy Mexican T-bill. After one period, you're going to get this 1 plus I Mexican peso interest rate. Or you can convert Mexican peso into dollar. You put that into dollar money market. After one period, you're going to convert dollar back into Mexican peso. Now, what is the problem with this one? If you do that, in fact, we don't have same risk, same return anymore because the obviously Mexican T-bill, US T-bill has different risk, have different risk. So where can we see these kind of things? We learn in the lectures this paper, Frankel and Rebic. They found many non-zero CIP violations. CID is just a CIP violations with 3 months T-bill and euro currency rate with the UK USA case and Canada USA case. What they find, case 1, if you use T-bill to compute CIP violations, even for these countries, these country pairs, there could be a big profit opportunity. But what they said is you shouldn't think about CIP violations easily with T-bill because you have to worry about political risk. You have to worry about default risk. If default risk are different, you need to take into account that. What I mean by that is in these equations, what's going on? Maybe risk with this one and this one could be different. Then high risk, high return, meaning we may expect to see this. If you see higher risk for this one, then the right-hand side should give you higher return. If the other case, if this one has a higher risk, then this return should be bigger than this one. So even though we have CIP violations with this inequality, that's natural thing because we have different risk because the one of the assumption is not true, right? So Mexican peso and US dollar case, we need to worry about difference in default risk. So some of the CIP violations you get using Mexican peso and US T-bill are not the risk-free arbitrage profit. It's a risk premium. Also, we need to worry about political risk. What is the meaning of political risk? When you buy Mexican T-bill, for example, actually you need to send your money to Mexico, an agent in Mexico, and ask that person to buy Mexican T-bill there, which means, well, when you use T-bill to exploit CIP violations, you need to move your money across different country. Then we talk about the capital control and exchange control during the lectures. You need to worry about whether, so let's say you make money by investing into Mexican T-bill. Are you able to send your profit back to your home country? It's about capital control. Exchange control means so you make money in Mexican market, so your profit is in Mexican peso. Exchange control means are you able to convert the Mexican peso into your home currency? That's so-called exchange control. So there could be this kind of risk. When you buy Mexican T-bill versus when you buy US T-bill, you have different political risk. When you invest into US market, you don't have to worry about capital control and exchange control. But when you invest into Mexican market, you have to worry about capital control and exchange control. So what I'm trying to say here is even though you don't see equality, they are not equal. Maybe the difference is coming from exploiting CIP violations using T-bill. Some of the profit could be political risk, the premium from taking political risk, or premium from taking credit risk. Okay, that's the one of the answer you can provide here. Why such returns can be considered as a reward for taking risk. Dollar and Mexican case, which since you have to send your money to Mexico itself, you have to worry about political risk. So some of the profit could be risk premium for political risk, the risk premium for taking credit risk. Also, we learn about Barber and Pecker. What was the Barber and Pecker? So Franklin Rebick says, when you compute CIP violations, you need to use euro currency rate. Then euro currency means you can borrow and lend foreign currency in one place in London. So there are no investment across different countries. So there are no difference in political risk. There are no difference in count default and credit risk. Why? Because you can borrow and lend from a group of bank with similar credit risk. When you borrow dollar in London, you borrow from a bank with good credit risk. And when you lend dollar in London, you lend dollar to bank with a good credit. So similar default risk, same political risk because everything is happening in London. So you don't have to worry about this kind of risk for euro currency rate. We just need to take into account bid-ask spread. So after Franklin and Rebick paper, every paper used the euro currency rate to talk about CIP violations. But remember, I can give you an exam question saying that you find CIP violation using T-bill. Then you need to consider these kind of issue there. If you are able to borrow and lend using euro currency rate, then you don't have to worry about political risk. You don't have to worry about default risk. However, still there are one more risk you have to take into account. That's the so-called counterparty default risk, the emphasized by Barbour and Pecker. So Barbour and Pecker compute the CIP violations. Do you have questions?
Yeah, I have a small question here. So, how can we know whether the currency can be traded in the external currency
So
market?
G10 currencies are basically traded in the external currency market. Other than G10 currency, like an emerging market currency, any emerging market currency, you cannot borrow and lend there. So you can go to HSBC and can you borrow like the Brazilian real or Mexican peso there? No. You can even deposit your home countries. You're from China, then you cannot deposit your home currency there. They don't accept that.
So they can only deposit like pound and or
G10 currency, I think. Maybe not here, but in London, there are so-called external currency market where you can borrow and lend G10 currency.
okay, thank you.
Okay. So Barbour and Pecker says using euro currency rate, so we don't have to worry about default risk or political risk, but still we are able to observe many CIP violations. So what is the reason? So Barbour and Pecker says there could be the counterparty risk in the forward contract. So in the lecture slide, in the lecture, we talk about this issue. So there is another way of interpreting CIP violations. So this is CIP equations where D is dollar and F is pound. So we interpret something like this. You can borrow dollar directly $1 today. This is the one you have to pay back after one period. So instead of interpreting this one as a return, so you put $1 after one period, you're gonna get this return. Instead of that, we can interpret this one as the cost you have to pay for borrowing $1. Then what you have in the right-hand side is the dollar interest rate from indirect dollar borrowing. What is the meaning of that? So we use this example, UK bank or UK company. During the global financial crisis, they cannot borrow dollar directly. They cannot borrow dollar directly. So this wasn't available to UK banks. Global dollar shortage issue. They need dollar for export and import. So they need to borrow dollar for their operations. But unfortunately, they couldn't use this one. So instead, what they did is the UK firm or banks borrow pound today. So UK firm, US institution, US banks or FX swap dealer. UK bank borrow pound today. So today, and give this pound to US bank and get dollar. So in this way, UK firms are able to get dollar today. And then they reverse that using the forward contract, which means after one period, so T plus one, let's say today is T plus one, they're gonna give dollar back to US bank or swap dealer, and they're gonna get pound amount. So this is the how to borrow dollar using borrowing pound and using FX swap. And we can interpret this one as the dollar interest rate UK company paid to US after one period. Now remember the spot price and dollar interest rate, they are given in the market. So the UK company cannot influence this kind of price. Only UK and US, the UK company and US bank or FX swap dealer, they can negotiate the forward price using forward contracts. The forward contract is between two counterparties, and they are always negotiating forward price with each other. Anyway, given these situations, what is the counterparty default risk? So in this FX swap case, US bank, US FX swap dealer give dollar today and get dollar after one period. The problem is happening in this side, the forward contracts. If UK banks do not pay back dollar for some reason, then US swap dealer has unwanted extra pound after at T plus one. So UK company, they don't fulfill their promise to pay back dollar. So US bank, US FX swap dealer, they get unwanted pound. Why this is the issue? During the crisis, first, pound was depreciating. So you don't want to have an asset with declining value. So US FX swap dealer, they don't want to have a pound. So they are worried about this risk, first. Second, during the crisis, typically US banks, they are worried about so-called bank run. Bank run means somehow the depositor of the US bank, they are worried about the credit risk with the US bank. So they worry about maybe losing their deposit because of this bank's bankruptcy. So they are trying to get their deposit. If everyone is trying to do that, that's called bank run. Then eventually US bank will not able to pay back all the deposits, so they're gonna be default. So US banks are worried about that kind of situation, so they want to keep dollar in their bank. So deposit is not in pound, deposit is in dollar mostly. So US banks do not want to have a pound, they want to keep dollar. So because of these two issues, bank run issue and the declining value of pound, they worry about this risk. What if UK company do not pay back pound after dollar after one period? They worry about that. So what they are going to do is to reflect that risk in the interest rate. So they're gonna reduce this one. Then the whole thing will be bigger. So what we have eventually is this inequality. So what is the meaning of this inequality? When US bank lend dollar through FX swap, or when UK firm borrow dollar through FX swap, US bank will worry about this counterparty default risk. Unless they got some compensations for taking that risk, they are not gonna lend dollar indirectly, even indirectly to UK company. So how they reflect that risk? By reducing this one, by increasing the right-hand side. So this inequality is natural if you think about counterparty default risk. And the difference is not risk-free arbitrage profit. It's the difference, the profit to US FX swap dealer is just the risk premium for taking counterparty default risk. So those are three risks we can think about to explain why you are able to make money when you have CIP violations for dollar and Mexican peso case. Well, this, if you write down like this, well, this was actually one of the past year exam questions. 50 mark for this one at the time. If you are able to write down CIP form for this one and explain a little bit about the assumptions, and then if you say this one, so you need to use treasury bill to exploit these conditions, and if you are able to explain default risk, political risk, and the counterparty default risk, you could get like around 40. So 40 out of 50. And the 10 more point was I wanted to include this as a part of answer. So what is this one? In topic 1, we talk about the crash risk involving with the Mexican peso. So we could draw something like histogram, something like this, and we see, I think, positive skewness maybe. So if dollar and Mexican peso, so there could be big appreciation of dollar or big depreciation of Mexican peso within a period. It's a big crash of the emerging market currency. Why that could be a risky thing? Well, if you expect crash risk for Mexican peso, well, here you are exploiting CIP violations, so you are removing FX risk. So you may think we don't have to worry about this kind of thing. However, if there's a chance of crash risk, that may increase the chance for counterparty default risk. So we need to, well, for example, here if this is the Mexican company, they have to uh, give back dollar and get Mexican peso after one period. They may not be hesitant to do this one if their currency has a crash risk, depreciate hugely. They're not gonna fulfill this contract, this um, promise. So negative skewness itself may not be relevant when you remove the currency risk using forward contract, but in fact, that could increase the chance to not to fulfill the forward contract itself. So it could be increasing the counterparty default risk. So at the time, I gave 45, about 45 if someone mentions something like this. If they are able to explain more precisely the role of skewness in terms of raising counterparty default risk, that person could get around 50. If the person just mentions skewness risk without any explanation, then just give some extra mark. Okay, so in summary, you expect to see something like this question in the exam. When you write down the answer, if I ask about CIP, you need to start with the CIP definitions with a little bit of explanations, and then you have to come up with your answer based on everything you know. So mostly based on the lecture slide on topic 6.1, plus maybe something else from other topics. So there could be some extra mark coming from this. But if you are just okay with getting 40 to 45, maybe you can just write down your answer based on the lecture slide only. Okay, so that's one thing I want to mention. And also I can give you this one here. What if I change the question to explain the reason why obtaining such return can be very challenging? So this one is not about interpreting this profit as a risk premium. This is about why you could have the CIP violations, right? Why we cannot exploit CIP violation. Why it's there, but the obtaining this risk-free profit is really challenging. It's involved with the other paper too. Though previously we were talking about risk story. Now this three paper talks about other reasons why you are not able to exploit CIP violations. Looks like this. So in the question, the part two question, we can say that instead of pound, you can put Mexican peso, right? Mexican peso. So this is the case why we cannot exploit this one. Dewey et al. Says the regulation is important. So the European Bank, so when you try to exploit this one, you have to buy or sell for the contract. So if the European regulation says if you buy and sell forward contract, if that forward contract remained in your balance sheet at the end of each quarter, then you have to pay some cost. You need to raise capital because you are making risky forward contract. So you need to raise some capital. When you raise some capital, you have to pay certain cost, right? So regulation is the reason why you are not able to exploit this condition easily. And also this Borio et al. Says this borrowing and lending is a leveraged induced investment. You do leverage investment here. The doing leverage investment is really tricky since the financial crisis because of so many things. So we talk about the summary of the issues in the lecture slide for this paper. And also this one says, when you think about violations, you need to use the realistic funding cost. So money markets are segmented. When you borrow dollar, maybe the interest rate you're gonna pay maybe just specific to you because based on your credit rating. So that's one issue. Second issue is when you exploit CIP condition with for $1, that's gonna be easy maybe because you don't have to pay that much interest rate for borrowing $1. But if you want to do this one for $1 million, you need to borrow $1 million, but the interest rate for that one is going to be huge. So scalability. So you need to also propose those kind of things to get perfect mark in addition to risk premium story if I change questions to this. So what I want to say finally here is that the part one questions are also important in the sense that each part one question asks you to summarize the key point about the key papers. You need to summarize this one clearly, and you need to use those summary to answer these kind of questions. So here you need, so for this question, you need to know about the Frank and Rebick paper and the Pava and Pekka paper. And to answer this question, you need to know about the other three papers, right? So when you prepare for the exam, first, based on part one questions, summarize everything using the review slide I provided, and compare review slide with the lecture slide. And if you think something is missing in the review slide, add that little bit. So start with the review slide, understand everything in review slide, and compare review slide with the lecture slide. You add something from the lecture slide if something is missing in the review slide, and keep that as the reference when you write down your answer for the exam questions. Basically, you need to think which part of the summary could be useful to answer the question you get the exam. So the one thing you need to make sure is, even though the question looks a bit difficult or looks a little bit different from what you see here, your answer should be based on what I teach during the lecture. So whatever you get as an exam questions could be a little bit more difficult or a little bit less difficult. Your answer should be based on the key point in my lecture slide, the key point, the summary of what you see here. Is that so I'm just trying to explain how to prepare for this exam question for the short. Have a very good summary of the key point and adding something from lecture slide, and try to think about a variations of part two questions and try to write down your own answer based on the summary or whatever. For the UIP part, so the first two questions are about in part one. First two questions are about empirical evidence on CIP, and in part one, the next two questions, 3 and 4, are about empirical evidence in UIP. So here they explain the UIP violations based on these three paper, and they explain UIP violations based on this Bruno-Meyer et al. So I just post the video clip on this one on Canvas, so you can watch that. So the answer for this one should be based on this slide. So there's a hint. The answer for this one is based on this slide, and hint are this. So let's talk about more important questions in part two questions. Again, you expect to see something like this in the actual exam. Let's say a quant in your company has developed a new zero cost investment strategy. So you invest something by the shorting something else. So buying something by self-financing, by shorting some strategy like a high minus low strategy. In FX market, so this is about the strategy in FX market based on, so you get this advanced strategy, the new strategy based on the statistical model with some good story, and would like to claim its potential to you, not you, the quant develop new strategy and want to say we need to implement this strategy. So you are the head of active investment. Let's suppose you use the Mank et al. Model as an asset pricing model or benchmark model. We want to know whether this strategy developed by the quant is indeed a new strategy or not. So how do we approach these kind of questions? As before, I want you to start with the writing down CIP form. When you try to answer this kind of questions, I want you to start with the writing down what is a UIP and what is the meaning of UIP violations. Let's talk about that using this summary here. What is the UIP? UIP is about also two different investment. Given these three assumptions, just like the first two are same as the CIP case, and we assume this risk neutral investors. So what you have in the left hand side, this is the, if you put, so F is pound, D is dollar. If you put £1, well, after one period, this is the return you're gonna get. What is this? So if you convert pound into dollar, put that dollar into dollar money market, but instead of using forward contract, you're gonna compute the return based on your forecast, today's forecast about the future exchange rate. So what you see here is the expected return from converting pound into dollar and putting dollar into dollar money market. After one period, you're gonna convert dollar back to pound using expected future exchange rate. So what you have here is a risk-free return. What you have here is the expected returns. Why do we have equality? Because we assume risk-neutral investor. They don't care about risk. There are some risk involved with this strategy, but risk-neutral investor, they just don't care. If the expectation gives you the 1 plus risk-free rate, then they think these two are same investment. So these are UIP. So you can mention this one first. And then what is the meaning of violation of UIP? So we can write down UIP in this form. So what is the meaning of this? High interest rate currency. So if D is bigger than F, is expected to depreciate. Well, it's better to say this. If F is bigger than D, then F is the high interest rate currency. If we have this inequality, so -1 in the right-hand side, we should have -1 in the left-hand side. So whole thing is negative here, whole thing is negative here. The negative means currency in the denominator is depreciating. So the S, this is future value. In the future, for the 1F, you expect to pay less D. Minus means this one is less than this. So you expect to pay less amount of D in the future. So what is the meaning? Higher interest rate currency should be expect to depreciate. That is the UIP. So first of all, this is the UIP conditions. And when UIP hold, this should be the case. Now, carry trade, you just need to know this one. The sufficient conditions for making profit by implementing carry trade is this one. If higher interest rate currency is expected to appreciate, just the opposite of UIP. So UIP says higher interest rate is expected to depreciate. But if higher interest rate currency is expected to appreciate, the violation of UIP, then carry trade will be profitable. Carry trade means borrowing low interest rate currency and invest into high interest rate currency and compute the expected return. That's the carry trade, right? So we learned these two. So what is the UIP? when CI carry trade is profitable. And in topic 6.2, we talk about empirical evidence on UIP violations. So we can test UIP using these regressions. Always when you have UIP, so means high interest rate currency is expected to depreciate, UIP. When you test UIP, you can remove expectations and you add error term and you add intercept and you add beta, the slope. And we assume this thing here, average error is equal to 0. So if this is y, if this is x, y is here, x is here, the whole thing is y. This one is x, alpha is this one, beta is the slope, and this linear relationship is the y is equal to alpha plus beta x. Well, the actual data will appear here. That's the meaning of error term. We want to find out linear relationship between y and x, but actual data it cannot be exactly on this line, so it can be everywhere here. So we allow error term for that deviations, but what we assume here is the average error is equal to 0. So we can test UIP using these equations, regressions. If alpha is 0 and beta is equal to 1, and if you take expectation on the regressions, you get back the UIP form. So we need to test this one to see whether UIP hold or not. What you find is negative beta. And we talk about the meaning of negative beta. Negative beta means, let's say IF is bigger than ID. So the whole thing is negative. Negative beta means negative become positive. So when IF is bigger than ID, when we have negative here, we have positive in this side. That means high interest rate currency F is expected to appreciate. Just the condition for profitability of carry trade. So what I'm trying to say here is when you answer these questions, you can explain the meaning of UIP violations and you can connect that with the profitability of carry trade. Why? Because of what we have been talking about here. The UIP says this should be true, which means high interest rate currency should be expected to depreciate. If that is not the case, carry trade is profitable. Now, using the empirical evidence, that's what we indeed find, right? So that's the explaining the UIP violations and connecting that with the profitability of carry trade. Now, when we observe profitability of carry trade, how do you actually implement that? You're gonna implement carry trade strategy in portfolio. You're not gonna just borrow one currency and lend to one currency. You're gonna borrow from many currency and you're gonna lend to many currency. So we talk about this zero cost dollar carry trade portfolio, and we call that as a HMLFX. So this is the alpha to the Farr-French three-factor model and CAPM. That's what we talk about. And Rusanov and Badland says alpha becomes beta. They propose this asset pricing model, the benchmark model. What is the meaning of benchmark model? Left-hand side, this could be return from any currency strategy. Something like what asked in these questions. Develop a new strategy, and based on that new strategy, they come up with the zero cost investment, something like high minus low. So what they did is using some statistical model in carry trade case, this one. So using statistical model, they come up with a new way to make profit by investing in FX market. Once you find that one, you're gonna implement that strategy in portfolio. So and then you're gonna rank carry trade case, all country based on interest rate. But with the new statistical model, with the new strategy, you're gonna rank all country in terms of new strategy, and you're gonna form portfolio, and you're gonna buy one, and you're gonna sell one to develop the new portfolio based on new strategy. And then, if you are able to make from that, that return could be explained as a risk premium. So what is the model we're gonna use? First candidate is this one. Second candidate is this one. Third candidate is this one. So I just want to interpret this question for you. What is the meaning of using an advanced statistical model to develop new zero cost investment strategy? If we use carry trade as an example, this is the HMLFX. This is the regression model we used. So using regression model, we develop carry trade portfolio strategy. We do the high minus low, and we find huge return, right? So this has the same structure. What this question says is they find a new, valuable, profitable the currency strategy. And then we want to know whether it generates alpha, whether the return from implementing that strategy is a really new one, something we don't know. So using the right benchmark model is really important. Here, we're going to assume this is a right benchmark model. What is the meaning of that? So benchmark model, so when you answer this question, you need to write down this model, and you have to briefly explain the meaning of each term and the meaning of this term here. This is the unexpected changes in global volatility in FX market. And delta and lambda is a sensitivity to, this is the average currency movement or dollar factor, and this is the volatility factor, the sensitivity. So what is the meaning of using this one as a benchmark model? If you earn some extra return from implementing FX strategy, it might be risky in terms of this factor or this factor. In order to understand that fully, you need to read this review slide. What is the meaning of that? Their idea is this: unexpectedly high volatility in FX is bad news to investor. So, well, let's use CAPM to understand this one first. Every asset pricing model defines bad time. So in CAPM case, market goes down, this is bad time. Bad time. So what is the risk premium? When market goes down, if your asset gives you big negative returns, that is the meaning of high beta. During the bad time, when market goes down, if your asset gives you big negative returns, you don't like that. You don't want to lose during bad time. So before buying that asset, you're gonna ask a premium because you are taking this risk, right? We can interpret every asset pricing model like that. So first of all, we need to know what is the bad time to each asset pricing model. So here, unexpectedly high volatile FX market is a bad news. You don't like to see huge volatility in any asset. So you don't like that. If carry trade or any strategy giving you big negative returns during this period, so whenever there's a high volatility in FX market, if your strategy give you lower return, you don't like that. So before investing into that strategy, you're going to ask a premium. So that means the lambda should be highly sensitive. Lambda is like a beta. So when there's a the increase in volatility, if your asset gives you lower returns, high lambda sensitivity, then you don't like that. So you're gonna ask a premium before investing that thing. So the over the time, your risk premium will be realized on average. How do we test? Well, we're trying to use this as a benchmark model. How do we answer whether this strategy is a new strategy or not? This strategy is a new strategy or not? We need to use regressions and we need to test on alpha. So how do we form our regressions? Again, remove expectations. So remove expectations, and add error term, and add intercept and slope sensitivity to each factor with this assumption. And collect the historical data and run these regressions. And let's say you find alpha is equal to 0. What is the meaning of that? So let's go to the summary a little bit more. You run these regressions. This is for the carry trade case. Instead of carry, you can put HML new. This is the high minus low return from implementing new strategy in the question we are trying to answer now. And then once you take expectation on both sides, you have expectations, you have expectation, you have expectation. The expectation of this one is equal to 0. And then if alpha is equal to 0, then this is just the benchmark model. The testing on alpha is giving us the answer for whether the strategy you are talking about is a new one or the one we already know. So go back to the questions. If you find alpha j is equal to 0, that means why you are making money by implementing this strategy? It's just a risk premium from taking either dollar risk factor or volatility factor. There's no extra return. The return you are getting just risk premium. There's no return. You earn more than the risk premium using this model. So for example, delta j is equal to 0, lambda j is equal to 1, and this factor gives you 6%, then what you are doing is just the strategy exposed to global volatility, or you may say that it's similar to carry trade. Let's say instead we find something, the alpha 10%, then this is not explained by any of these factors. This is a new return. So we can say that this is a very successful new strategy. So in order to answer these questions, okay, to get the perfect mark 50, you need to explain what is the meaning of zero cost investment strategy, high minus low. So you can start with first, let's say you develop a new strategy, and based on new strategy, you're gonna form portfolio, FX portfolio, and using that portfolio, you're gonna buy at high, you're gonna short sell, you're gonna financing that by short selling low, and then you want to test whether the return from this strategy is a new one or not using benchmark model. How do you test that? You're gonna run these regressions and you're gonna test on the alpha. If alpha is not equal to 0, that means that what you find is the new strategy. You have to explain this step, right, to get the perfect mark. Now, what we discussed in the lecture, we use a carry trade return, and we use the same structure. We find the carry trade is profitable using the UIP violations, and we form a portfolio, and then we talk about high minus low, and then we talk about testing the return from carry trade portfolio based on several asset pricing model. If alpha is equal to 0, then we explain why it's profitable to do the carry trade. If alpha is equal to, it's not equal to 0, then they may say there are something extra you earn more than what these benchmark models say you should earn. So this is just applications of the whole thing we learn to a new strategy. Now the problem is, in the actual exam, I may ask to come up with your own benchmark model. So here I assume, so this is also part of the practice questions. So at the time I gave you the benchmark itself. Then you can just write down benchmark and you can go like this. But in the actual exam, this year exam, I may not give you any benchmark. Then you need to come up with your benchmark model. What kind of benchmark model you can use? It should be based on everything should be based on the lecture slide. Well, if you are able to give more than what you learn in the lecture slide, you will get some extra mark, but that's not necessary mostly. If you want to get like a 45 out of 50, it's not necessary to do that. So it's too much. So your answer should be based on what you learn in the class. The most important thing, which is missing in our part 2 question here, is what is the benchmark you want to use? So this guy says volatility is important. This guy says liquidity is important. Well, actually, this is missing, but if you go to the lecture slide on this one, you'll find they use the equity market volatility as a factor for this one. If you are not sure, one thing you can do is you combine all three factors, which means ERJT minus RFT is equal to this factor plus this factor plus this factor plus this factor. So if you're not sure which model is a good model, maybe you can use combination of everything as your benchmark model and think about alpha. That's kind of one way of approaching this kind of question. Or if you think somehow for certain strategy, if that strategy is more relevant in terms of taking volatility risk. So when you say something like, if you implement certain FX strategy, you think it should be exposed to volatile risk. Whenever there's a high volatility, you may lose. If you think that is the right way of thinking about that, you can put volatility factor, but I think that could be too much. So at the undergraduate level, I think you just need to combine what you learn in the lectures as factors to approach this kind of question. One more thing. Actually, I mentioned this one in the lecture slide. This one should be return factor. So, well, in your answer, you have to briefly explain what this means. If you just write down this one as the unexpected changes in FX volatility, and you get slight negative mark. The reason is that during the lecture I explained you have to use so-called return on factor mimicking portfolio. The testing thing, we have these assumptions behind this whole testing things. Every factor you use should be the return factors, should be returned from implementing certain strategy. So remember topic 5, all those factor, five factor model, Carhart momentum factor, every factor was constructed using portfolio, using actual asset. Everything was a return. In this topic 6.2, unfortunately, sometimes this is not the returns. This is just unexpected change in volatility. Or the following one, this is unexpected changes in illiquidity. It's not the return. It's not the asset traded in the market. So you need to mention briefly, this one should be in fact the factor mimicking the return on factor mimicking portfolio. If you mention that, that's perfect.